Before you buy another share of Tesla or Palantir, you need to hear this, because some Wall Street analysts are predicting these stocks could crash by as much as 94%. If you're investing in AI stocks, this could impact your portfolio in a big way. Are these bold predictions justified, or is this just fear-mongering? Let's break it all down before it's too late. Artificial intelligence is reshaping industries, economies, and our technological future. Its market spans sectors like healthcare, finance, and transportation. While investors are excited about AI's massive upside, experts warn that not all leading AI companies are built to last. Intriguing, isn't it? Let's dig in. For years, AI has captured the attention of both professional investors and everyday traders. Imagine software that learns, adapts, and even makes decisions on its own. That's the promise of AI, a promise that PwC estimates could boost global GDP by up to 26% by 2030. Incredible, right? However, with huge potential comes significant risk. Not every AI-driven company will benefit over the long run. Wall Street buzzes with anticipation for AI's growth, yet some experts set very low price targets, warning of steep corrections. In fact, a few top AI stocks might drop as much as 94%, according to some predictions. Can you imagine that? Let's take a closer look at these companies to understand the risks and rewards. Let's start with Palantir Technologies, ticker PLTR. This company has been one of the standout success stories in the AI space. Since early 2023, Palantir's stock has soared by more than 1,500%, reflecting enormous investor enthusiasm. Palantir is known for its sophisticated data analytics platforms. Its Gotham system, for instance, is a robust AI tool that assists government agencies with mission planning and execution. Meanwhile, its Foundry platform helps corporations unlock insights from their data in ways that were previously unimaginable. With multi-year contracts and a track record of generating steady revenue, Palantir has earned a reputation as a critical player in data-driven decision-making. But not everyone is convinced. Despite these successes, some analysts, like RBC Capital's Rishi Jaluria, warn of a potential downturn. Jaluria recently raised his price target for Palantir from $11 to $40, following impressive fourth-quarter results and upbeat guidance for 2025. Yet he remains deeply skeptical about the company's long-term growth prospects. How can a company with such robust platforms face a 61% potential decline? According to Jaluria, several factors contribute to this caution. First, consider the company's flagship product, Gotham. While it's been a major profit driver, its market is inherently limited. Gotham is designed primarily for use by the US government and its close allies, meaning that even with growing global demand for AI-driven intelligence, Palantir's customer base is capped. Does it make sense for a company with such a narrow focus to sustain the meteoric growth investors have come to expect? Then there's the issue of valuation. Currently, Palantir trades at an astronomical 83 times its sales, a figure that far exceeds what historical norms would suggest is sustainable. Traditionally, even the hottest tech stocks tend to see price-to-sales ratios in the 30 to 40 range at most. If history is any guide, such a lofty valuation might eventually come crashing down to earth. Do you think investors might be overestimating Palantir's ability to keep growing at these dizzying rates? Finally, there is the ever-present risk of an AI bubble. We've seen time and again how market excitement around new technologies can lead to inflated valuations. Remember the dot-com era when even the most unproven companies saw sky-high stock prices? Many experts believe that AI could be following a similar pattern. Even though Palantir has a portfolio of long-term contracts that might cushion the blow in a downturn, no company is entirely immune to the whims of emotion-driven investing. Are we witnessing history repeat itself? Moving on, let's examine Tesla, ticker TSLA. A name that has become almost synonymous with both electric vehicles and cutting-edge AI. Tesla isn't merely an automaker, it's an innovation powerhouse that has fundamentally disrupted the transportation industry. Its vehicles are renowned not just for their electric powertrains, but for their advanced autonomous driving capabilities powered by AI. Tesla's full self-driving FSD software is designed to navigate the complexities of public roads with minimal human input. Yet, despite its pioneering efforts and record-setting growth, Tesla is also under a cloud of skepticism. GLJ research analyst Gordon Johnson has a starkly bearish outlook on Tesla's future, predicting that the company's stock could drop by a staggering 94%, bringing the price down to just $24.86 per share. Such a dramatic forecast begs the question, how can a company that seems to be on the cutting edge of innovation face such a dire fate? Johnson's analysis rests on a few key assumptions. He starts with a 15x forward earnings multiple and then applies a 9% discount rate, leading him to his unsettling conclusion. While his numbers might seem extreme, they point to genuine concerns about Tesla's valuation and business model. Tesla's growth has been fueled by its first-mover advantage in the electric vehicle market, but even first movers can face stiff competition as markets mature. One of the major challenges Tesla currently faces is pricing pressure. Since 2023, the company has initiated multiple rounds of price cuts on its EV models. These discounts are meant to stimulate demand in an increasingly crowded market, but they also compress profit margins. When a company continuously lowers its prices, it raises questions about its ability to maintain profitability in the long run. Do you think that constant price reductions could undermine Tesla's market dominance? In addition to pricing challenges, Tesla's revenue model relies partly on non-core income sources. A considerable portion of its pre-tax earnings comes from selling regulatory tax credits to other automakers, interest on its vast cash reserves, and even adjustments related to digital assets. While these income streams have helped boost Tesla's bottom line, they are not directly tied to its core competency of designing and selling electric vehicles. If these ancillary revenue sources diminish, Tesla might find itself with a significantly lower profit margin. Does relying on such side income streams make for a sustainable business model? Another factor adding to the uncertainty is the role of Tesla's charismatic yet controversial CEO, Elon Musk. Musk's vision and leadership have undeniably driven Tesla's meteoric rise, but his ambitious promises have sometimes proven elusive. For over a decade, Musk has confidently stated that Tesla's FSD technology is on the brink of achieving full Level 5 autonomy, a promise that has yet to materialize despite numerous assurances. Each time expectations are raised and then unmet, investors are left wondering, can Musk deliver on his lofty goals? Or is this just another case of overpromising and under-delivering? Looking at these numbers, it's clear that both Palantir and Tesla are operating in completely different leagues, yet they share some striking similarities. Palantir, with its $257 billion market cap and strong 80.25% gross margin, is highly profitable in its niche, but still has a relatively small revenue base of $3 billion. Meanwhile, Tesla's sheer scale is undeniable, raking in $98 billion in revenue and holding a massive $1.1 trillion market cap. However, its gross margin of 17.86% is significantly lower, showing the pressure of a highly competitive EV market. So what does this tell us? While Palantir thrives on high-margin AI-driven contracts, Tesla operates on volume, constantly pushing for growth despite shrinking margins. But here's the real question. Can either company justify its valuation in the long run, or are we looking at stocks that could be overhyped? Let me know what you think in the comments. The challenges faced by Palantir and Tesla highlight a bigger trend. AI is reshaping industries at an incredible pace, but with that comes volatility. The stock market thrives on excitement, and while AI offers groundbreaking potential, overvaluation remains a real risk. Are we in an AI-driven market bubble? Investors must rethink traditional valuation metrics, as today's leaders could quickly fall behind. AI's impact extends beyond stocks. It's transforming economies, job markets, and industries worldwide. The key is balancing optimism with caution. Before we wrap up, here's a final thought. If you had to bet on one AI company to lead the industry over the next decade, which one would you choose? Let's keep the discussion lively. Drop your thoughts in the comments below. And if you found this insightful, like and subscribe to Simple Investing Secrets for more smart investing strategies.